S&P 500 year-to-date returns 24%. If you look at QQQ, also about like 23%. So this year, definitely so far, before end of the year, right now it's like mid-November. We have one more month to go. Hopefully, stock market still stay at this kind of level and not crashing down before year end. Okay, now my portfolio, 54%. But bear in mind that this percentage, right, is quite volatile one. See on the chart here, this is year-to-date, right? It went up to 50% and then came back down to 25%, then went back out again. So a lot is driven by the heavy allocations in my portfolio, for example, like Nvidia, Tesla. I mean, it's quite volatile just because of the stocks that I own. If you look at my top holdings, definitely 54% returns is all contributed by all the top big tech companies that are doing very well this year. Started from Nvidia, 194% returns. Year to date, less than 1 year, it's like triple already. Then TSMC also doing very well, 83%. So I would say that for Nvidia, I actually didn't, discuss about these stocks in detail before they ran up. So because I thought that the stock valuations was quite high, I didn't actively, discuss about it in details. But for TSMC, definitely I thought in detail. You can, scroll back to my videos, let's say videos 1 year ago, 2 years ago. TSMC, I talk about them like all the time. And then the third one is Tesla. Tesla, 29%, I think like slightly better than S&P 500 and QQQ. But again, these companies is also very volatile. Right before the US elections, it was down, it was lagging. And then now after elections, Trump won the presidency, Tesla shoot up, right? So a lot of all these returns actually came after the elections. Then the fourth one, Amazon, 35% return, also very decent, significantly above S&P 500. And I have quite a heavy allocations as well. Lastly, Microsoft. Actually, Microsoft is the one that is not outperforming S&P 500. But I think that these companies definitely have good future, good prospect. I'm actually thinking that I'm quite confident that this company will do well. Okay, in terms of my allocations, here are the allocations. Everything is shown here. Nvidia 21%, TSMC 11%, Tesla 10.5%, and the rest are, my top, let's call it like top 6 or 7 of them contributing very sizable of my portfolio allocations. The other 1 quarters, let's say from IUIT, which is the tech ETF, and all the ETF are, for example, like QQQ, IWDA, CSPX, EMI, all these are, I would consider broad-based ETF, and all these add up together, right? Together with my smaller portfolio, they are like just 1 quarter. So 3 quarters are really all the high convictions, big tech names, including Tencent as well, right? Google, Tencent, Apple, these are tech companies. So I have quite large allocations to tech companies because these are the areas that I'm familiar with. I studied them for quite some time. I feel comfortable owning them, looking at their growth prospect, looking at their margin, looking at their, overall business quality, business mode. That's why I'm comfortable holding them. But I'm not saying that these companies that I own, definitely they will outperform, because there will be period that they underperform. So for long-term followers, you will know that, during, let's say like 2022, when I talk about portfolio, I'm not talking about the returns, I'm talking about how much I lost, right? So it goes up and down, but over time, as long as the companies are making money, their fundamentals remain strong, they remain disciplined in their executions. So I do see that they can have bright future. So that's why I'm having sizable allocations onto these tech companies here. So just for context, right? This is a screenshot that I pull up from my very, very first video. This video was November 2020. So almost 4 years anniversary already when it comes to this YouTube channel. I really, when it comes to allocations, I don't think this is like, any secret of this. It's just my preference. And my portfolio, my bias. I think that's very important for anyone who's watching this video, consuming my content, right? So I think that's the transparency, I think is important. So this is not latest. This is just November 2020 portfolio. And you can just observe, right? I pull this out just to show you that, the companies that I have invested in, say for example, Apple, Amazon, Microsoft, Nvidia, Tencent, Tesla, TSMC, all these companies, right? They're already there 4 years ago. You don't need to watch every weeks of my video to know the actions that I did during that week. I'm not trading, I'm more like just spend a lot of time understanding the companies. One, I have good understanding of the companies. I will just invest in them, add to the positions over time, and then just hold and hold and hold for most of the time, right? Especially like this year, right? And also last year, I haven't been adding a lot into all these names. I'm just holding because the valuation seems a bit high. I'm patient. I just hold, do nothing, and just let it ride, right? So I would say that definitely different investor, there are different period, right? There will be period where you have a lot of saving, or you have a lot of saving that you want to allocate in. You will build your portfolio aggressively, right? During certain period. After that aggressive period, right? I would say that you will spend most of your time holding, because even if you are still buying, for example, right? But but as your portfolio become big enough, so you, even if you are adding, it doesn't feel like you are adding, it just contribute a small percentage to your portfolio. Most of the returns or most of the changes in the portfolio actually came from just the market volatility, and market volatility hopefully is like volatile but still drifting up because the companies that you pick is showing good progress, good profitability, and so on, right? When it hits that level, when it is sizable enough, actually what you feel is just like, you're holding, you're not doing much anymore. But I would say that it's good to hold and not doing a lot and just let all these companies continue to compound, instead of like the need to keep allocate money from A to B, C to D, keep changing. And if you keep changing and you know what you are doing, I think that's fine. The challenges is that if you are making all these tweak too frequent and actually you don't have a lot of idea like what you are doing, you are basically just chasing the next hot stocks, right? I think that would be very dangerous. So I would say that if you don't know in terms of like picking companies, just stay with diversified portfolio, like for example like S&P 500, VWRA. Those are definitely good idea. Those actually simplify your investment and make you don't spend too much time thinking about all these portfolio allocations, right? I think that's actually a good idea. But for those who are passionate about picking stocks and you just want to allocate into the companies that you have high conviction on, I would still say that you are picking stocks doesn't mean that you need to, in and out. Just hold on to the portfolios. I think that's the most important thing to do, because even for the best company in the world, right, it doesn't shoot up in few months time. It actually take time to go up one. And usually by taking time, I mean at least a few years to have the results. That's the philosophy that I'm trying to encourage you all to stay focused, stay long term. That's my takeaway here. I would say that this chart, right, is showing my portfolio value over time. Actually, I keep track of this partly also using report coming from the brokerage. Even though, let's say if you have multiple brokerage, right, it takes a bit of effort for you to compile your portfolio. I would say that it's still worth it to track your portfolio over time, because I purposely hide the scale here, because I think the scale is not important, because I'm showing my portfolio here. I'm building this portfolio since 2017. It's like 7 years already, it's quite some time. So for you who are watching, you could be started your portfolio 3 years ago, 5 years ago, even 15 years ago, right? But you will have a version of this chart of yourself, right? Your own portfolio over time. I just don't want you to investing in stocks, but you don't know how your overall portfolio evolve over time, because I think it's good to track your progress, your personal progress, right? Your allocations as you build your portfolio, contributing money into it. I think what is important is the journey going up, right? Because you can see that there will be part of the journey where you just, building up slowly because your saving could be, like still low while you're young, right? Then there will be a period where, for example, you putting your money into stock market more aggressively. Say, for example, let's say if there's a market crash and you just want to DCM more, right? You definitely do that. And then you see that there's aggressive growth in certain period. And there will be period where because of recession, because of market corrections, your portfolio dip over time. I think that's fine, because we are long-term investor here, right? So if you invest and you just hold, as the stock market crash, right, your portfolio also come down, and you need to be okay with that, right? Because say, for example, if you are putting 100,000 into the stock market, and then market just correct by 30%, for example, right, which happen from time to time. If that 30% drop, you should expect that your portfolio also drop 30%, or even more if you have a concentrated portfolio like mine, right? So you just need to be at peace with it, and then just experience the drawdown, continue to build your portfolio over time, continue to put money, continue to buy good companies. So those, you need to execute it on a consistent manner, and over time you can see that the results is there, right? Which is what I'm trying to show here, which is not some theory, this is not theory. This is not like, I invest using Buffett, using whoever style. It is not. It's actually a lot simpler than that. It is just telling you that as long as you consistently implement your strategy, and the strategy can be as simple as just a DCA in diversified ETF, or just buying the companies that you like on a consistent basis, right? You are looking at a similar chart pattern as what I'm showing here, which is my portfolio value over time. When I look at this, it's not like, we are celebrating the amount, it's how much, right, at this point. It's not like that. It's just to show that anytime you are looking at your portfolio, this is a snapshot of it. This is just, you can call it like maybe one fifth of the total journey. As time goes on, this chart will continue going to the right side, going up, hopefully. I want all of you watching here, right, just consistently track your portfolio value over time, and just enjoy the ride, because I have my journey, which I'm sharing with you all. All of you, right, each of you should have your own personal journey as well. And hopefully over time, let's say after you're investing for 5-10 years, right, people ask you, hey, actually, how do you invest, right? You can actually pull out your journey and share with people that your journey is such and such, right? So I'll say this is very important, because what I try to advise against, right, is that you buy and then you sell. You buy and then you sell. Then after after, let's say, like 5 or 10 years, you're doing that buy, sell, right? Then people ask you, actually, how much money that you have in your portfolio? You say, oh, I'm actually having, let's say, 100,000. And why is it 100,000 and not 1 million, right? I would say that most of it is not because you picked the wrong stocks. It's because you didn't diligently put money. You could be buying and then selling, and then once you have cash, you go and spend the cash somewhere else, right? Then your portfolio can't compound. It really need the time to compound, and it need the time for you to put your money aside, not touching it for considerable time, and then looking at the portfolio, like stocks having 30-50% gain, and you still don't sell, don't cash out, don't take your money out, still continue to put your money in. I think that's how we compound the portfolio to a huge sum amount of money over time now. So that's the recipe. Okay, it's even simpler than whatever, like so-called value investing strategy. Those, if you pay few $1,000, go and subscribe to those investment courses, they have to come up with some, fancy system. This is not even a fancy system. It's a lot very simple. But the implementations take a bit of discipline. I think that's the hard part. And I would say that most people, they don't have like-minded people like you and me here, right? Sharing these kind of things, right? They can't let this kind of thinking sink in, and it actually is a mental block to build the portfolio. I would say that most people actually belong to that category. So I'm trying to, build a community where this is the community where we all invest for the long term. Okay, just briefly talk about the stock chart just now, right? Stock chart, why portfolio building is very important is because if you look at S&P 500 index, right, I need to pull this chart like for the 122 times already. I need to pull it up, keep pulling out, telling people that you see over time, right, this is on a log scale, right? It goes up smoothly, right? There's a compounding magic to it. I can't promise you this one will not come down, because there are periods where you see, for example, like in 2000, it come down, and then after 2008 or 2009 global financial crisis, it also crashed down. Although it looks more on the scale here, but actually if you zoom in, right, it's actually easily, like 40-50% crash. So even at today's level, right, if you invest in stock market, right, it is possible that your portfolio or overall stock market can drop 30, 40, 50, even 60%. That's actually possible. It can happen. And if you stretch long enough, right, it will happen. So that part, the volatility part, is something that you need to be okay with. If you're not okay, of course, you need to allocate some portions of your money into some safe investment. Say, for example, like money market funds, bonds, or whatever, as long as it is considered safe, like lower volatility. S&P 500 or like overall stock market is still a good place to build wealth. Why is it good to build wealth here? It's just because the long-term returns from stock markets is still better compared to, let's say, your fixed deposit or money market funds. So this is actually, this kind of charts, right? This is like real history. This is even longer, like 200 year plus, taken from Jeremy Siegel's books, right? So there are research to show that actually stock outperform. So here you can see that the real returns from stocks, right, is 6.9% over a long period of time. It is easily 3% more than stock market. And even today, right, when people say that S&P 500 is overvalued, we debate about the PE, even that, right, consider that when you assess the equity risk premium of stocks, right, and then you look at the bond yield level, right, I would say that from today's point over the next, let's call it like 20 years, right, stocks is still going to outperform bonds. Maybe the outperformance is not 3% here, but easily, let's say 1.5% outperform bond is still an outperformance, right? So stocks is still the way to build your wealth. It's just that it is volatile, and then not everyone have the mental capacity to withstand the volatility. Some people, they throw 100k into stock market, the stock dropped 20%, they lost 20k, they kind of like, they can't get past that kind of volatility. They have to sell, So if you belong to that group, then you either don't invest in stock or you invest just a small portions. Say, for example, you have 100k to allocate, maybe just throw in 10k so that it is small enough not to mess up with your, like your psychology. But for those who have the mental capacity and you trust your research into, can be, research into stock market in general, or it can be research into individual stock. As long as you have convictions, you have the mental capacity to withstand the volatility, right? Your portfolio, which consists of stock portfolio, right, and maybe some fixed income, some cash, you have some war chest or whatever, I would say that as long as it consists of stock, then it will do well over time. Just because of most of the returns, right? Let's say if a companies operate, right, you look at their balance sheets, they have bonds, they basically borrow the capital and they have their shareholders, right? Actually, the upside, right, will flow to shareholders mostly, because for bonds, they just pay the interest, that's it, right? But any upside, let's say for example, companies like Apple, right, any huge upside, right, actually it flows to shareholders in the form of dividends and share buyback. So this one you need to bear in mind. And even though like gold is doing quite well recent years, right, but if you look at this chart over the long period of times, I think stocks still outperform even commodities. Because it is like behind all these stocks, it is business that is productive. They have a business model, they generate cash flow, they grow over time. So there's a lot of magics when it comes to investing in stocks. But just looking at the history, right, it really outperforms. Just the volatility is the one that people can't take it. Okay, I think that's most of my sharing already, but I just want to quickly touch about these topics that came out this week, right? So basically, I think in Singapore Parliament, there's this discussion about financial influencer must be licensed and regulated if they provide advice. This is the hot topics this week. They have a flow chart, right? Actually, this is not new. This document came out in 2019. I think the key point here is to ask yourself, right, are you providing financial advice? And if you read all this flow chart here to judge whether you are providing any financial advice, right? So I just want to, give some opinion in terms of my kind of content, right? Where does it flow here? Because I actually studied this flow chart and just try to argue, on both sides. After reading these things, right, I just want to say in a very confident manner that I'm not providing any financial advice in all forms of my contents. Any contents, it could be, my expos, it could be my video, like talk sing song during weekend, all these things. It is not a financial advice because I never ask for your personal, let's say, details, right? The stuff that I share is mostly publicly, not mostly, it's like all of them are publicly available. You don't have to trust everything that I say. You can actually go and Google, go and use ChatGPT to verify any statement that I made, right? It's just that instead of like just quoting stuff, right? Say for example, I read certain thing that I tell you, or I read a book that I tell you, it's all factual based, right? Which most of the people think that factual based stuff is actually quite boring. But in terms of my sharing, of course, there are stuff like this, which I would say maybe already 70-80% of the material is the stuff that I know, and stuff that I know, I actually know it through reading, watching video, and so on, right? And I try to put in the remaining 20 or 30%, which is my personal take, which is stuff that is under the opinion category. When we get into opinion category, right, it gets a bit like a little bit into the gray territory. Because when I voice my opinions, and then some people may think that, it is some form of inducement, like I try to influence you into investing into stocks that I own. I mean, that part, right, is a bit like 100% say that I'm not. Like I tell you how good is Microsoft, good prospect, how good is TSMC, good management, quality management, all those things, then financials goods. After I telling all these things, then I say, actually I'm not trying to induce you to invest. So sometimes we kind of like step into all this, like gray territory when talking about all these things already. So it gets into like dangerous place for me because I'm not supposed to give financial advice because I don't know your situations. And let's say if I say, TSMC good, and then you go and invest and then it dropped, then you blame me. So I actually put myself at a dangerous positions for sharing all these things just because in the financial world, we are talking about money. Money is important. People might actually follow the so-called like advice, right, or opinion, right, and go and lose money and they can't take it, right? So it's a bit gray here, but the questions that I'm asking myself is that should I, just because of all these things, is dangerous, should I just refrain from talking about all this topic? Because if I stop talking, right, then no liability at all. I won't be even in gray territory. I'll be totally safe, right? But the thing is, if I stop talking about like stop investing, financial things in general, then I might as well just close down my channel because my channel is like I would say 90% is all about all this sharing, right? Try to have more discussion, try to have more like productive discussion over investing topics. When I see people have some misunderstanding on certain financial concepts, I try to like weigh in, explain things. Hopefully we all learn some things. I also learn from other content creators. I think very useful stuff, right? So I hope that these entire things about like all this licensing stuff, right, just my personal opinion is that I hope that they don't overdo it in terms of regulating the financial content area, because I think Singapore is a small market, it's a small community. People want to feel related when it comes to consuming financial advice, right? You don't want this entire financial content space is like all of them are angmo, talking about US situations and nobody talk about like Singapore situations, right? Singapore context, right? So you still need local financial influencer to continue to keep content, and I hope that these things won't turn to be an area where it become too hard to create contents. So I still wish to like stay here sharing all this journey with you all, knowing friends and so on. So I hope that this will continue, and that's my take on this. See you in the next one. Bye bye.